On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. Let's run through everything that happened last week, then let's talk about what's coming up in the week ahead. Starting with global share markets, as I always do, it was a bit of a mixed bag out there. We saw the S&P 500 in the US rise 1.1%, UK shares and European shares both up 0.3%, the Aussie market up 0.5%, and at the other end of the spectrum we had emerging market equities which finished 0.7% lower, and the Japanese market also fell about that level, down about 0.6%. The local market continued to edge higher. The NZX 50 was up 0.2%. That saw it finish the month of November up 3.4%. That's a very good monthly return, the best since July, in fact, and the local market is now up 11% in 2024. So that sees it on track for its best year in four, the best year since 2020, and all of those gains have pretty much come since the end of June. So it has been a very strong second half of the year for the New Zealand share market. Interest rates fell back in most places. In the US, we saw interest rates decline quite a bit, actually. The 10-year Treasury yield fell from 4.4% to just under 4.2%. And here in New Zealand, interest rates fell back too on the back of that RBNZ rate cut that we'll talk about soon. There was a bit of volatility on the day, but in the end, the 5-year swap rate here in New Zealand finished the week 15 basis points lower at 3.73%. There have been some mixed messages for global bond markets in recent days. Last week, we had the Federal Reserve's preferred inflation measure, PCE inflation. We'll talk about the detail of that shortly. That was in line with forecasts, so good news, stable as expected. We also saw the minutes from the November Fed meeting, which pointed to further gradual easing. However, on the other hand, you had US initial jobless claims lower than expected, so a little bit stronger than people were expecting. And very early last week, President-elect Donald Trump did say that he would very quickly implement tariffs on China, Mexico, and Canada, which are three of the biggest trading partners of the United States, and those would in all likelihood be inflationary. So bond markets have been just wondering which direction they should go in, but week to week we did see them lower at the end of last week. Running through some of the key events, and here in New Zealand it was obviously all about the Reserve Bank and the OCR. So, as widely expected, we saw the Reserve Bank cut the official cash rate by another 50 basis points. So it came down to 4.25%. Now that's well below the recent peak of 5.5%, 1.25% lower, and it's the lowest we've seen since early 2023. But the market was equally interested, probably more interested, in the forecasts and the accompanying monetary policy statement. And this is really what got people's attention, what impacted the currency, wholesale interest rates, and future expectations. So, to wrap up what the Reserve Bank did, they have got a little bit more optimistic in places, particularly about the short-term prospects for the economy. They did increase their growth estimates just a little bit, and they did reduce their forecast for how high unemployment will go. Unemployment at the moment is 4.8%. The Reserve Bank thought it would be in the fives by now. They still see it rising from here, but not quite as much. So the November forecasts see the unemployment rate peaking at 5.2% in March, which is less than the previous peak of 5.4%. Then they see it coming down. So I guess the bad news is it will get worse before it gets better, but the good news is it won't get as bad as they thought before. In terms of their inflation forecast, they see domestic inflation pressures being a little bit more persistent than before. That non-tradables inflation expected to be a little bit stickier, although the annual headline inflation rate, which is what they're really targeting, that still stays in that 2 to 2.5% zone over the coming 3 years. So it still stays largely where they want it to be. In terms of the housing market, a little bit more upbeat too. They've essentially upped their house price forecasts for the next 2 years. Before, they were in that sort of 5 to 6% growth zone for 2025 and 2026, and they've upped that to a range of 6 to 7%. For the OCR, which is what we were most interested in, they actually expect to cut more aggressively in 2025 than we'd seen in August. So the new track, the new forecast path, implies another 0.5% of cuts by June 2025 compared to what we saw from the Reserve Bank in August. However, it still sees the OCR ultimately bottoming out at about 3% in early 2027. So, in short, the Reserve Bank has said that it will front load more of its easing. It will do more early next year rather than waiting or going more slowly. However, the end point isn't too different. In fact, the end point lifted a little bit, which is interesting. The next OCR decision comes in mid-February, and that's almost 3 months away, so a lot can happen, a lot could change. At the moment, the default position seems to be that we'll get another 50 basis point cut. That was sort of ambiguous in the forecast set, but in the press conference, Adrian Orr pretty much said we're going to cut by another 50 in February if things play out the way that we're expecting. So forget about what you see in the numbers to some degree, and I think we're all taking his comments as gospel right now, that the default is another 50 in February, and then they'll step down to 25 basis point cuts from there on. But a lot could change, and there's a lot of data to come out between now and mid-February, so we'll wait and see. Something else that I think is really interesting, and I don't know the answer to this, and I don't know if anyone else does really either, at least with certainty, is just where does the OCR ultimately end up? What is its terminal or neutral level? The Reserve Bank sees it settling at about 3% or just slightly above those levels. And when you look at most of the major banks, they're in a similar position. I think there's a couple that have got 3.5, there's a couple that have got 3.25, someone's at 2.75, but the average is about 3.25. And that's interesting because I think that is probably higher than where some people are expecting the OCR to go. If you think back to the pre-COVID period, the OCR was 1.75 for a long time. Then I think it came down to 1%. That's where it was as we headed into COVID. So we're in that 1 to 2% range. And if it settles at 3 or even a little above 3, maybe as high as 3.5, like a couple of the economists are expecting, that means that mortgage rates will still come down, but they won't come down nearly as much as a lot of homeowners and borrowers are expecting. So that's really something we need to keep a close eye on. Those mortgage rates might just settle at about 5%, which is very good compared to 7.5, but it's not as low as some people are hoping for. You've got some people out there who are hoping that mortgage rates come down into the 4s or even go down into the 3s, and I think that might just be wishful thinking rather than the reality of the situation. So that's something we need to keep a close eye on as well. Right, so beyond the OCR, what else did we see out there? We had business confidence here in New Zealand too. The ANZ Business Outlook survey for November was out. Looked solid. Headline confidence did slip marginally, but it was at a 10-year high, so not surprising, and it still stayed at very elevated levels. The own activity measure actually pushed higher. That rose to 48. That's the strongest since May 2014, so it's a more than 10-year high. Inflation indicators eased, which is good because I was a little bit concerned about this. The net proportion of firms intending to raise their prices over the coming months fell, and inflation expectations came down as well. That net proportion of firms intending to raise their prices, that had been rising for a few months straight, so it's good that that's come back a little bit. In the US, the key thing that we saw last week was PCE inflation, and this is the Fed's preferred inflation measure. This covered the month of October, and the good news is that it was in line with expectations. The headline PCE rose 0.2%, that's the same as the previous month. The core PCE increased 0.3%. That was the highest in 7 months, but we did see the annual headline PCE rise to 2.3, and the core PCE inflation rate increased to 2.8%. That's the highest since April. So a little bit higher than the previous month, but no worse than expected. So good news in the sense that there was no negative surprise there, and you're still in the twos. So I think that's something the market will be pretty comfortable with. The Federal Reserve meets on December the 18th, which is, I think, Thursday, a fortnight from Thursday. It's usually a Thursday morning when you get the announcement here in New Zealand. At the moment, the odds are about 2/3 in favour of a 0.25% cut. So we should get another cut from the Federal Reserve as we head into that important Christmas period. Right, looking ahead to this week, and it will be a busy one in terms of international economic releases. In the US, the focal point will be the jobs report, which is out on Friday. This will be the last major economic release ahead of that Federal Reserve meeting. We'll also get the latest ISM indices, and we'll get the University of Michigan survey as well. So the first thing we'll see will be the ISM Manufacturing Index, which is out on Monday night. And ISM stands for Institute of Supply Management. This is essentially an activity measure. We'll get the manufacturing one on Monday, and then we'll get its services counterpart on Wednesday. Last month, the manufacturing ISM slipped even further. It's at a 15-month low, so the manufacturing sector in the US not doing particularly well. It's actually been in contraction for 23 out of the past 24 months. But more encouragingly, the services ISM remained easily in expansionary territory. It actually rose to the highest level in more than 2 years. So we'll get one of those on Monday. We'll get the other one on Wednesday. Then on Friday, we'll get the jobs report, and that's all in US time. So it will be Saturday morning here in New Zealand when we get the results of that jobs report. This will be really important. This will be watched very closely, partly because the labour market's always important, but also because you've got that Fed meeting, and the labour market is a key factor in whether the Fed pauses or whether it keeps cutting interest rates. And something else that will make this one really interesting is that in October, so last month, we saw just 12,000 new jobs created, and that was the lowest since the end of 2020 when we were in the middle of that COVID sort of period. So that was extremely weak, but it was heavily impacted by strikes and bad weather. So the market sort of ignored it. The unemployment rate was unchanged, underemployment was unchanged, but that jobs number, that headline number that everyone focuses on, was pretty terrible, to be honest. So for November, markets are expecting normal service to resume and for 200,000 new jobs to have been created. The unemployment rate expected to remain unchanged at 4.1%. So we'll be watching that, and that will feed into expectations and forecasts for what we see from the Fed in a couple of weeks' time. On the central banking front, we will also hear from Fed Chair Jerome Powell. He's speaking on Wednesday at an event, and European Central Bank President Christine Lagarde also speaking on Wednesday. So in addition to the economic indicators, we will get some comments from a couple of central bank heavyweights midweek too. Elsewhere out there in the world, November PMIs will be released in China. In Australia, we'll get the latest GDP report for the September quarter. We'll also get retail sales early in the week. And here at home, it will be a little bit of a quieter week. Obviously, we had a big week last week with the Reserve Bank. This week, there's not a whole lot to keep an eye on, but we will get the results of another dairy auction early on Wednesday morning. Dairy prices have obviously been ticking over nicely, and we've had a string of positive developments for the sector. So a fortnight ago, we saw prices up almost 2%. They're up more than 20% this year, and at the highest levels since the middle of 2022. And Fonterra has increased its milk payout forecast for this season to $9.50 at the midpoint, which will be the highest of all time. And there's potentially some upside to that, depending how things play out. If you see prices keep drifting higher, if you see the currency remain pretty subdued where it has been, then $10 is not out of the question. Finally, there are a few corporate earnings releases to keep an eye on, not so much here in New Zealand. That mini reporting season through November is behind us now. There was quite a bit to watch last week. Fish and Paykel Healthcare, Ryman, Turners, but it sort of quietens down from here on. Internationally, a couple of things that I will be watching for: Salesforce result on Tuesday and a Lululemon result on Thursday, among other things. So there you go. That's another week down. Thank you very much for listening. I do appreciate it, and we'll talk again soon.
For more insights, visit craigsip.com.